Good morning. This is Sarb Lally from the BC Teachers Federation. I'm the Assistant Director in Pensions and Group Benefits, and I'm coming to you today on September 9, 2022 from Vancouver, British Columbia on the unceded territories of the Musqueam, Tsleil-Waututh, and Squamish First Nations. And today's pension presentation is going to be on the Teachers Pension Plan, information for members. So let's get started before any further ado. And I'm going to share my screen. There we go. So Teachers Pension Plan information for members, fall 2022. Okay, the goals of our presentation today is to give you, the members, an understanding of how the Teachers Pension Plan works, life events and pension impacts, and factors to consider when you're choosing a pension option. So let's talk about your pension plan. The Teachers Pension Plan provides, in terms of a pension income, uses a mathematical formula using your highest average salary, your pensionable service, and an accrual rate to determine what your lifetime pension is going to be. And when you retire, you receive a guaranteed monthly lifetime pension. There is some inflation protection, as cost of living adjustments are granted subject to available funds in the inflation adjustment account. And as per the last valuation, the inflation adjustment account was very healthy and sustainable. So we expect that cost of living adjustments will continue to be provided well into the future, because that is a priority of the Teachers Pension Plan. How about group health benefits when you retire? Well, the Teachers Pension Plan has Green Shield Canada as its insurer, and they have group rates available to Teachers Pension Plan members for extended health and dental benefits. And but you have to pay the full cost of the premiums. And later in this presentation, we'll take a look at what the current premium cost is. Finally, can you run out of pension income? No. Under the defined benefit pension plan that we have, the basic lifetime pension is guaranteed for your life. So that's a great thing. So how is the pension plan governed? Well, there's a joint trust agreement between the BCTF, that's a plan member partner, and the provincial government, which is the government partner. And those are the two partners, and they select 5 trustees each that are appointed to the Teachers Pension Board of Trustees. Any decisions that are made by those trustees require 7 out of the 10 trustees to vote in favor of that decision. The trustees have hired 2 main agents. One is the administrative agent, the BC Pension Corporation. And what they do is they make sure that you get paid on time. They collect all of your service and annual salary information from your employers, and they calculate what your pension is going to be based on the Teachers Pension Plan rules. The other agent hired by the trustees is the British Columbia Investment Management Corporation, also known as BCI. And they take all of the money that comes into the pension plan from the employers and from you, the members, and invest those dollars into a very well-diversified portfolio, which we'll take a look at later in the presentation. So as of December 31 of 2021, let's take a look at what our membership looks like in the Teachers Pension Plan. So you can see that we have just over 50,000 active members. So those are teachers, vice principals, principals, directors of instruction, superintendents, etc., who are paying into the Teachers Pension Plan. They're working and contributing. We have 12,714 inactive members. Those are members who have stopped contributing to the Teachers Pension Plan prior to the age of 55 and left their money in the plan so that it continues to grow, and maybe one day they will take that money out as a lifetime pension. And then we have 40,073 retirees. So those are members of the plan who are receiving a pension as of December 31, 2021. So we're well over 100,000 members of the teacher's pension plan. Next, how is the account financed? And here we'll take a look at the basic account. So as you can see, the employer and the member contribute funds into the basic account, and those funds are then invested and continue to grow the account. And as of December 31, 2021, there was $31.54 billion in that basic account. And that basic account is then used to pay all of the retirees their retirement pensions every month for the rest of their lives. And the contributions, what level do you pay currently? Well, if we look at the far right on this screen, you'll see that the employee pays 11.17% of their salary. That's broken up into 8.17% into the basic account, 2% into the inflation adjustment account, and a further 1% into a rate stabilization account. So in case there are ups and downs in terms of investments, ups and downs in terms of the plan performance, and we need to add some more money into the basic account in order to keep your premiums stable, then the teacher's pension board of trustees will borrow from the rate stabilization account in order to keep the rates stable. And the employer, they pay 11.30% into the pension plan, and it's also divided into the basic account, the inflation adjustment account, and the rate stabilization account. So the inflation adjustment account, how much money is in there? Well, as you can see in the middle of the screen, as of December 31, 2021, there was $7.2 billion in the inflation adjustment account. And that's what leads to what I called indexing, or the cost of living adjustments that are made to retirees' pensions every January 1. And that money then goes into the basic account, which raises the level of your pension based on the indexation, the cost of living adjustment, and that becomes your new lifetime pension. And the following year, if there's another increase awarded by the teacher's pension board of trustees based on cost of living rising, then that will then go into the basic account, and that'll become your new lifetime pension. And so it just compounds year after year as inflation adjustments are granted. So the cost of living adjustment is either going to be the Canadian Consumer Price Index, the year-over-year increase from September 30th to the next September 30th, or the amount the inflation adjustment account can afford. And currently, the inflation adjustment account can afford, or has been affording, the full Canadian Consumer Price Index increase for the last 20 years. And as I said earlier, it's applied each January to your retiree pension. And once it's granted, it becomes part of your lifetime pension. So the increases compound on top of each other year after year. Full indexing is not guaranteed, but as I mentioned, the inflation adjustment account had $7.2 billion in it as of December 31, 2021, and the actuaries deemed that it was in a fully sustainable amount on their last valuation. So what kind of impact has indexing had on members' pensions? So as an example, I've got a pension at $25,000 in 2002, and through the indexing that has been granted over the last 20 years, in 2022, that $25,000 pension would have increased by $11,279 to become a $36,000 pension for that member. On the left-hand side of the screen, you can see the most recent cost of living adjustments. So that big number on 2022 stands out at 4.4%. 2023 looks to be another big number. What that will be, we won't know until the inflation numbers are in at the end of September of this year, and then the Teachers Pension Board of Trustees will meet and they'll award the increase, and it'll be announced to the membership in the new year. So how is your pension calculated? Well, your pension, as I mentioned earlier, is calculated based on a formula. And having the pension plan be redesigned in for the beginning of 2018, we have a couple different calculations. One for your pre-2018 service, and another calculation for your service going forward from 2018. So let's take a look at that pre-2018 service. So for any time that you worked and contributed to the pension plan prior to January 1, 2018, your basic lifetime pension will be calculated as follows. You take 1.3%, multiply that by your highest average salary up to the YMPE, and the YMPE stands for the year's maximum pensionable earnings. So that's the maximum salary that is set by Service Canada based on the industrial average of wages in the country. And so they set that every year and announce that every year at the end of the year for the following year. So the pension plan uses that YMPE, multiplies that by 1.3%. Any part of your salary that's above the YMPE is multiplied by 2%. And then that's added together and multiplied by your years of pensionable service prior to 2018. And lo and behold, that creates your basic lifetime pension. And that's a monthly pension guaranteed for your life. Now, for service prior to 2018, there's also a bridge benefit that members who are under age 65 when they retire are eligible for. So that bridge benefit is 0.7% multiplied by that highest average salary up to the YMPE, multiplied by that pre-2018 pensionable service. So remember, the first part of the previous equation was 1.3% multiplied by the HAS and the pre-2018 pensionable service. Well, this 0.7% then takes that up to a 2% pension calculation. So up to age 65, your pension is basically 2% times your highest average salary. Now, this bridge benefit is provided only until age 65. And the reason it's provided only until age 65 is because typically the Canada Pension Plan would then start for a member at age 65, and Old Age Security would start for a member at age 65. And they would roughly replace that 0.7% from the bridge benefit in order to continue to give you basically a 2% accrual rate pension for the remainder of your life. Now, there will not be any reductions to your pension on that pre-2018 service if you retire between ages 50 and 59 with factor 90. That's your age plus your contributory service added together to make 90. Or if you're between ages 60 and 64 and you have at least 2 years of contributory service, or you're at age 65. So at age 65, you receive an unreduced pension regardless of what service you have in the plan. Now, there are going to be reductions if you retire early. So, for example, if you retire between ages 55 and 60 with at least 10 years of pensionable service and either 20 months of contributory service or 10 months of pensionable service in the last 2 years, the reduction is the lesser of 3% per year if retiring before age 60, or 3% for every year that your age plus contributory service is less than 90. There's a 5% reduction for every year you're under age 65 if you have less than 2 years of contributory service. And finally, for any other retirement scenario, it's the lesser of 5% for every year you are under age 60, or 5% for every year your age plus contributory service is less than 90. I know, whole lot of math there. Fortunately, the teacher's pension plan does these calculations for you, and you don't have to do these calculations yourself. You can always go into the teacher's pension plan website, into My Account, and take a look at what your latest calculations are for your pension based on the age that you want to retire at. And you can save up to 10 of those pension estimates right there in My Account on the website, so that you can go back and view them at your leisure. Now let's talk about that post-2017 service and the pension formula. There's only one formula here, and it's very simple. You take 1.9%, multiply that by your highest average salary, and multiply that by your post-2017 pensionable service, and that gives you your basic lifetime pension based on the service that you have from January 1, 2018 going forward. Now, for your post-2017 pensionable service, there'll be no reduction in your pension if you retire between ages 55 and 60 with at least 35 years of contributory service, or if you're between ages 61 and 64 with at least 2 years of contributory service, or once again, if you retire at age 65. The reductions kick in at 4.5% per year if you retire before age 65 and you have less than 2 years of contributory service. There's also a reduction. If that doesn't fit your scenario, but you are still retiring early, this scenario will fit. If you have 4.5%, or your reduction will be 4.5% for every year you're under age 61 if you retire before age 61 and have more than 2 but fewer than 35 years of contributory service. All right. Now, your highest average salary is based on your pensionable earnings. So let's take a look at what your pensionable earnings include. Your pensionable earnings include your salary, any administrative, supervisory, or special qualification allowances, the salary indemnity plan allowance, the recruitment and retention allowance, if it's employer paid, any maternity top up or WCB top up that you receive if you're on a WCB claim, any work that you do at summer school, night school, and adult education, if it's in the bargaining unit or if it requires a certified teacher. And also payment for preparation time. So if you're a teacher who gets paid in lieu of preparation time, you're a part-time teacher, then that payment is part of your salary. Please note in red, it says this list is not exhaustive. The teacher's pension plan has a long list for employers about what pensionable earnings includes. I just included the main topics that I find with members that would be applicable to members. But if you're not sure of whether or not the salary that you're receiving or amounts of money that you're receiving from your employer are pensionable, you can always contact the teacher's pension plan and they'll let you know. Okay, I've talked about highest average salary a few times. So how is that highest average salary calculated? So what they do is they take the last 5 years of full-time equivalent work that you've done. So if you're a 1.0 FTE teacher, that's your last 5 years of teaching, if those are your highest 5 years before you retire. So in this scenario that I've got on the screen, this member's best 5 years were their last 5 years. So, and they retired at the end of June. So you would take the 6 months from January to June, add it to the last 4 years, plus the last 4 months of 2017, add all those salaries together, and then divide that salary, that cumulative salary, by 60, because that is referring to 60 months, 12 months in every year. So 12 times 5 makes 60. And that gives you a monthly highest average salary of $7,763 in this case. For part-time members, so just to review, the key numbers here are the 50, because those are the 10 months per year pensionable service that you earn as a regular teacher, multiplied by 5 makes 50 months. And 60 months is what you divide that total by, because you receive a monthly pension 12 months of the year from the pension corporation. So your highest average salary has to be calculated on an annualized 12-month annualized calendar. And that gives you your total. Now for part-time members, similar calculation, except you may have to go further into the member salary, go a few more years if they've been working part-time to get the full 50 months of salary. As you can see in this example, we had to go into 2016 because this member had some part-time teaching years in 2018 and 2019. And once again, important numbers are the numbers that bring you up to 50 months of pensionable service. And you take that cumulative salary, divide it by the 60 months for the 5 years, and you receive the monthly highest average salary total. Okay, earning service. There are 2 types of service that you earn with the teacher's pension plan. One is contributory service. So you receive 1 month of contributory service for any pension contribution made in the month. And so you could work a 0.2 FTE and work half a day in that month, but for that month you would receive 1 full month of contributory service. There's also pensionable service. Now that's based on your actual working time, how much you actually worked or how much money you actually earned in relation to your 1.0 FTE contract. So if you earned your full salary from the employer in a month, then you receive 1 full month of pensionable service from the teacher's pension plan. If you took any discretionary days that were unpaid, well, that will reduce the pensionable service that you earned. And that pensionable service is used to calculate the amount of your pension. All right, now let's get to the significant life events and your pension. So one significant event is a relationship breakdown. So under the Family Law Act, people living together in a marriage-like relationship continuously for 2 or more years are considered to be spouses. And a member's pension is an asset that may be subject to division. Former spouses may claim their share of the pension and become a limited member when the plan member reaches age 55, whether they are retired or not. So that's some basic information about what happens on a relationship breakdown. For more information, more detailed information about what happens when relationships break down or when they break down, what can happen, please visit my mini seminar, attend my mini seminar on relationship breakdowns, which is available on the BCTF YouTube site. So go to YouTube, type in BCTF videos, subscribe, and on the pensions playlist, you'll see a mini seminar on relationship breakdowns. You can also obtain all this information on the Teachers Pension Plan website. Just type in relationship breakdown into the search engine and start reading from there. Okay, the next thing that we want to talk about is if you take a leave of absence. So you can take different types of leaves of absence. One is a general leave of absence. So this is any leave where the Employment Standards Act doesn't require the employer to share the cost of purchasing the leave. So remember I talked about a discretionary day earlier. So taking a discretionary day would be a general leave of absence. And if you wanted to buy that service back for that discretionary day, then you, the teacher, would pay both the employer and the employee contributions. So the 11.3% the employer pays and the 11.17% of your salary that you would pay to buy that back. And it goes without saying, the more service you purchase, the more your pension will increase. Now, there's also leaves of absence under the Employment Standards Act. And some of those include pregnancy leave, parental leave, compassionate care leave, family responsibility leave, domestic leave, or death of a child leave. There are also other leaves in the Employment Standards Act, and you can go there and take a look at the various leaves that are covered by the Employment Standards Act. Now, for these leaves, the teacher pays the employee portion only. Okay, so all you pay is the 11.17% of your salary to buy back that leave. So that's very important to know. Okay, there are also things called arrears. This is where required contributions were not made by the employer. So the employer has to make their contribution. And there are two types of arrears. One is payroll arrears and the other one is enrollment arrears. So if it was a simple payroll mistake by your employer, then the employer must make their contribution and the teacher must make their contribution as well to correct the payroll error. But if there was an enrollment error and arrears that resulted, then the employer has to make their contribution. But if you weren't enrolled properly in the teacher's pension plan, then you have a choice as to whether or not you make your contribution. But if you don't contribute, then you don't receive the full pensionable service. And as it says there, your service is prorated based on your contribution choice. So if you make the full contribution that you're supposed to, then you'll receive the full pensionable service. Okay, you can also be laid off by your school district. That's a significant life event. But fortunately, you can buy service for a layoff period as a general leave of absence. That means you pay both the employer and employee share. If you were laid off and placed on a recall list, or if you worked a continuing contract or had seniority rights at the time of layoff and were eligible and chose to join the recall list. And finally, if you worked a temporary contract and were laid off before the contract expired and were eligible and chose to join the recall list, you may apply to purchase the remaining months of your temporary contract. There are limits on purchases. So for general leaves, the limit is up to 5 years of general leave can be purchased by any one member. For pregnancy and parental leaves, you are allowed to purchase up to 3 years of combined pregnancy and parental leaves. And for layoffs, the limit is that you have 6 months that you can purchase per layoff period. So if you were laid off for more than 6 months, the maximum that you can purchase is 6 months. There are also deadlines that the teacher's pension plan has in place for members to purchase their leaves of absence. And generally, they're within 5 years from the end of the leave if you were on an approved leave from your employer. Now, the third row down, you see it says ESA approved leave, that's Employment Standards approved leave, continuous contributions. So for Employment Standards Act leaves, you can actually make a monthly contribution to the teacher's pension plan for your pensionable service while you're on the leave. But you have to do that within 30 days of starting that leave. If you don't do it within 30 days of starting that leave, then you have to wait until the end of the leave and then make a lump sum contribution. Now, why would you want to make continuous contributions? Because the key here is that the amount that you have to pay to purchase a leave is based on the salary that you're earning at the time that you apply to purchase the leave. So if you wait until the end of a leave, when you may have had salary increases based on going up a step on the salary grid or a negotiated salary increase occurring, you're going to pay more to buy that same amount of leave as compared to if you had just made monthly contributions while you were on the leave. So that's very interesting. That's a new feature, a relatively new feature added by the Teachers Pension Board of Trustees over the last couple of years. And then for layoff periods, you have to purchase that leave within 30 days of ending employment if the layoff period is under 6 months, and within 30 days after the 6-month period ends if the layoff period goes beyond 6 months. Okay, so that's very important to know. Once again, the cost to purchase a leave, if it's an Employment Standards Act leave, it's 11.17% from the employee, 11.3% from the employer. If it's a general leave, the employer doesn't pay anything. The employee pays the full 22.47% to buy that leave. And how can you do it? Well, you can always pay cash. Okay, and that includes using your RSP room and transferring money from your RSP over to the teacher's pension plan. Contact your financial institution if you want to do that. You can also make contributions per payroll period while you're on your leave, pursuant to the Employment Standards Act. And if a leave extends beyond the maximum provided in the Employment Standards Act, the additional leave may be purchased as a general leave. Okay, so for example, if you have 3.5 years of maternity and parental combined that you want to purchase, that 0.5, that's beyond the maximum of 3 years that you can purchase that as a general leave. But then you would have to pay the full 22.47% for that one, as opposed to the 11.17% that you paid for the pregnancy and parental leave. Okay, now let's talk about what you can't purchase. So you can't purchase any time in which you were not employed by the school district. So if you're not an employee of a school district, you can't purchase teacher's pension plan service. That makes sense, right? Any period of time when you were employed with a non-plan employer. So if you left the school district and you went to work somewhere else that's not associated with the teacher's pension plan, well, you can't have that employer, contribute to the teacher's pension plan on your behalf, and you can't make voluntary contributions to the teacher's pension plan. Sorry, no can do. Any time with the employer in a position covered by another BC public sector plan. So if you're like a QP member working for the school district, well, you have your own municipal pension plan that you're contributing to. You can't also contribute to the teacher's pension plan, or, vice versa. If you're a teacher, you can't contribute to the municipal pension plan. Okay, you also can't purchase service to bring your part-time employment up to full-time where there's no leave of absence. So that's different from if you have a 1.0 FTE assignment, you take a part-time leave and you work 0.6, and the 0.4 is a leave of absence, you can purchase a 0.4. But if you or the school district change your assignment from a 1.0 to a 0.6 FTE, for example, and there's no leave of absence there to bring you up to 1.0, then you can't take that 0.6 FTE and purchase 0.4 to make it a 1.0 FTE. So hopefully that's clear. If there's any confusion, please give me a call. You also may not purchase a period during which the member contributed to another registered pension plan. Okay, so that's also a no-go. Service which would cause the member's pensionable service to exceed the maximum permissible, right? So for full-time equivalent teachers, it's 1.0 FTE or 10 months of pensionable service in a year. So you can't go ahead and say, well, I want to contribute, extra, and for this year I want to buy 12 months or 14 months of pensionable service. No, you can't do that. You're only entitled as a regular full-time teacher in a regular public school to 10 months of pensionable service for that year, and that's the maximum. And also service on or after January 1, 1993, for which the member waived enrollment. So there was a period of time prior to 2005 where members who are working different percentages were able to tell their employer whether they wanted to participate in the teacher's pension plan or not. And if you waived enrollment in the teacher's pension plan at that time, you can't now go back and try to purchase that time. And finally, any time that's spent on a strike or a lockout or say a suspension without pay, you're not allowed to purchase service for that period of time. Okay, child rearing credit. So this is for members who quit work or have an employer approved leave of absence to directly and actively care for a dependent under the age of 7. Okay, and you're allowed to purchase up to maximum of 5 years credit. It doesn't cost you anything, so the purchase price is 0. And it's only contributory service that you're receiving. And that contributory service can help in calculating factor 90 or in calculating your 35 years of contributory service to entitle you to an unreduced pension. And the application is available on the Teacher's Pension Plan website. Okay, transferring service from one jurisdiction to another. So that would result from the life event of moving from one province to another province. So changing, say from teaching in Alberta to teaching in British Columbia, or from teaching in British Columbia to teaching in Alberta. You can transfer service between public sector pension plans across the country. The Teacher's Pension Plan has transfer agreements with many public sector pension plans across the country. They have agreements with all of the teacher pension plans across the country. You just have to fill out the appropriate form from the Teacher's Pension Plan website and submit that to both pension plans. So let's take Alberta for an example. You would submit one form to Alberta, and you'd also submit a form to British Columbia. Those two plans would let you know how much pensionable service you're allowed to transfer out of, say, the Alberta plan, and British Columbia would tell you how much pensionable service they're going to give you credit for your Alberta transfer, and whether or not you have to pay any money to increase the amount of service that you're going to receive from British Columbia. Okay, now let's move to pension options. So you're going to retire. What are some key factors to consider? Well, one is whether you have a spouse or dependents to protect. Secondly, what will your income and expenses look like in retirement? How's your health and the health of your spouse? That's an important consideration. And also, when will you collect your Canada Pension Plan and your old age security benefits from the federal government? So your pension options with the teacher's pension plan include, if you're not married, a single life pension option. So single life is available if you're single or your spouse has waived their right to the minimum 60% joint life option. Here you can choose a lifetime monthly pension payment with no guarantee, or a guarantee period of 5, 10, or 15 years. So what that means is if you die before the end of the period, the remainder of your pension will be paid to your beneficiary. Another option is a joint life option, and that pension is guaranteed for your lifetime and your spouse's lifetime. But you have to have a spouse in order to choose joint life. You can't just name some random person off the street as your joint life partner. Remember, you have to be living continuously with that spouse for 2 years or longer in a marriage-like relationship in order for them to be considered a spouse. So your options with joint life. First is 100% joint life option. So that pays your full lifetime monthly pension to your spouse after you die. So first you get your pension. Once you die, then your surviving spouse receives your pension. The exact same amount until they die. So that might be an important consideration, 100% joint life, if your spouse has no other significant sources of retirement income, because that will provide them with the largest pension, monthly pension payment for the remainder of their life. Other joint life options are anything less than 100% with no guarantee, or a 5, 10, or 15-year guarantee. So that means from 1% joint life to 99% joint life. But remember, if it's less than 60% joint life, your spouse has to sign a waiver. So with these options that are less than 100%, your full pension is guaranteed for the guarantee period if you choose a guarantee period. It provides a larger income during your lifetime to you than the 100% joint life option. But on the other hand, the lower the joint life percentage, the less your surviving spouse will receive. So on the 100% joint life, you and your spouse will receive an equal amount. Once you die, your spouse then receives the same amount. For 80% joint life, you'll receive that much more than if you chose 100% joint life. And once you die, your spouse will receive that much less than if you had the 100% joint life option. And it works the same way with 60%, 40%, 20%, 10%, 1%. But remember, you can't choose a 60% joint life option unless your spouse waives their right to that minimum 60% in writing. Now with guarantee periods, some people want to have a guarantee period for that security, feeling of security, that if both they and their spouse die before the guarantee period, the benefit will be paid to their beneficiaries, i.e. their children, for example. Okay, you can also choose a temporary annuity as a pension option, in addition to your joint life pension or your single life pension. Now, this can be chosen to top up your pension. Okay, think of it as a top up until age 65. Once you hit age 65, the temporary annuity will end. It's sort of like the bridge benefit. Goes to age 65 and it ends. So if you have significant expenses that you're expecting at the first few years of your retirement, the temporary annuity may help you meet those initial expenses of retirement, like paying off a mortgage, for example. Now, if you have significant RRSPs or other income that you're expecting to receive after age 65, the temporary annuity option may help lower your income after age 65 and reduce your income taxes. So some considerations. Like I said, a temporary annuity is only available to age 65, but after age 65, it will reduce your lifetime income. So if you choose a temporary annuity up to age 65, then your pension after age 65 would automatically reduce because you're not receiving the bridge, but it'll reduce further because you took a temporary annuity. And the younger you are when you retire, the bigger the impact on your pension after age 65, because of course, you're receiving a temporary annuity longer for more years up to age 65. If you're married, a reduced lifetime pension might have a significant impact on your spouse or your dependents. If you have a guarantee in place for your pension and you die prior to the end of the guarantee period. Okay, now while you're alive, if you run into terminal illness or disability that's certified by a doctor to be terminal or likely shorten your life considerably, then you're entitled to actually access a shortened life expectancy benefit from the plan. What that does is it converts all or part of your pension to a series of payments for a fixed term, and you can withdraw the commuted value of your pension as a lump sum in either one payment or multiple payments. But if you have a spouse, you must file a valid spousal waiver with the pension corporation. Next, let's talk about Canada Pension Plan benefits. The amount of your Canada Pension Plan depends on the age you decide to start your pension, how much and for how long you contributed to the Canada Pension Plan, and your average earnings throughout your working life. The Service Canada takes all that information, puts it together, and then provides you with your Canada Pension Plan. The average monthly amount for new recipients at age 65 in 2022 is almost $780. And the maximum amount for new recipients at age 65 is about $1,250. So most teachers who work a full career will usually get the maximum or close to the maximum from the Canada Pension Plan. You can start collecting your Canada Pension Plan before age 65 as early as age 60. However, that will be reduced by 0.6% for each month, up to a maximum reduction of 36% if you start at age 60. If you start collecting your Canada Pension Plan after age 65, payments will increase by 0.7% each month, up to a maximum increase of 42% if you start at age 70. Okay, so you can wait to collect your Canada Pension Plan and collect more, or you could collect it earlier and collect less, but for longer duration. So it depends on where you are in your life, what expenses you have, etc. Lots of stuff that a member would talk to a certified financial planner about when deciding, when to start collecting their Canada Pension Plan. Old age security. So that one is a government benefit that's based on your residency. Okay, living in Canada depends on how long you lived in Canada, and it's funded by income tax payments. It's available at age 65. Make sure you apply 6 months ahead of time. And the current maximum for old age security is about $650 per month. Now, for 2022, old age security payments will be clawed back or recovered by the government if you're making more than $79,000 a year. That'll be reduced by 15%. And there'll be full recovery of the old age security payments if your income is over $133,000 in the year, which kind of makes sense. If you're making $133,000, you likely don't need the old age security payments. So just to sum up the type of retirement income that you can get from based on your employment and government benefits, you have your basic lifetime income from the teacher's pension plan, and you can start that as early as age 55, and you can start as late as age 71, and that goes until you die. The TPP bridge benefit, that goes until age 65 or your death, whichever comes earlier. Your teacher's pension plan annuity also goes to age 65 or your death, whichever comes earlier. And then we have your Canada Pension Plan and old age security benefits that are payable until your death. Okay, now in retirement, I mentioned at the very beginning that you're eligible for extended health and dental benefits, and you may enroll at retirement or later if you're covered by another plan. The coverage can include your spouse and dependents at full premium cost. And those premiums are normally deducted straight from your pension payment before it's deposited into your account by the pension corporation. And here's a look at the current premiums as of February 1, 2022. So extended health care benefits for 3 people or more, $352.52 per month. And the dental plan is divided up into a basic plan and an enhanced plan. The details of both the basic and the enhanced plan and the extended health care coverage are available on the Teachers Pension Plan website. Just type in extended health coverage, and then you can find the Green Shield Canada booklet on the website, and you can review the different coverages that are available. I also have a webinar, a mini seminar webinar available for you to view on the BCTF YouTube site on the extended health care and dental benefits. So for more information, you can go over to that mini seminar and have a look at that information. Okay, now when you start your pension, when does it actually start? Well, it starts on the first day of the month following your final paid workday, or the first day of the month in which the teacher's pension plan receives your completed application package. However, if you had no work from July to September and your district accepts your termination letter, your pension will be effective July 1st, but you have to apply before September 30th. So this does happen often with members who make it through the summer fully intending to go back to school and start teaching in September, but either something happens or when Labor Day comes around, they're like, nope, I've had enough, I want to retire. And so the teacher's pension plan will allow them to retire retroactively to July 1st. But that's as long as they didn't teach any summer school or you don't do any TOCing in that month of September. And your pension will be deposited always 2 banking days before the end of each month, with the exception of December, where it's 2 days before Christmas, December 25. Okay, let's take a look at one summary about the considerations for when you want to retire. So I've talked about your health and your life expectancy of you and your spouse. Those are significant considerations. You also want to take a look at where your dependents are in their lives, and if they continue to need your regular monthly income, or if they're fine, or if they need you to have a guarantee in place for the pension option that you choose. What financial commitments do you have? Do you have a mortgage? Do you have outstanding lines of credit that need to be paid? Are you going to be able to manage to meet your financial commitments on your reduced pension income? Do you have other sources of income or another job that you want to go to after you retire from teaching? Do you want to convert your group life insurance policy into an individual life insurance policy? Or do you want to buy life insurance from another company? And are you going to be able to manage your affairs, your business affairs, when you are in retirement? Or are you going to need a power of attorney to do that for you? You also should be updating your will, making sure that everything is consistent with respect to the beneficiaries you choose for your pension and a teacher's pension plan, and if you're going to mention those beneficiaries in your will. You might also want to consider membership in the BC Retired Teachers Association. The first year of membership is free with the BCRTA. After that, it's currently $42 per year to be a BCRTA member. And there are also local fees ranging from $5 to $10 if you want to join a small local chapter. And there are about 50 different chapters of the BCRTA in the province. So when should you apply for your pension? Well, once you know that you're going to retire, apply between 30 to 90 days before your pension effective date. The best way to do it is online through My Account. That's if you're going to choose one of the standard pension options that they have. If you're going to choose a non-standard option, one that's not provided on the Teachers Pension Plan website, then you need to fill out a paper application. And for those, I would recommend applying as close to 90 days before your pension effective date as possible, so that they have time to process your paper application and then get your first pension payment out to you on time. Okay, now prior to applying, you can also book a 30-minute phone appointment with a Teacher's Pension Plan representative. So this is very new from the Teacher's Pension Plan, and I put the internet link on the screen for you. And you should, don't forget this one, it's very important. Provide at least 30 days notice in writing to your employer that you're going to retire. Okay, make sure they know. And also make sure you know when your benefits from your employment are going to end. And you do that by contacting your human resources department. And then you can figure out when you want your benefits in retirement to start. Finally, here's some resources that you can go to on the web. The first and most important resource is the Teacher's Pension Plan website. This is a great resource. Their search engine is very intuitive. Type in any word and you will likely find information that is going to help you learn about your pension or help you choose what pension option you're going to take, or any questions that you have. Just type it into the search engine and go from there. Service Canada. Their information is there so that you have it available to you when you're going to apply for your CPP and your old age security. The FP Canada website refers to Financial Planning Canada. We recommend that you talk to a certified financial planner before deciding on what pension option you want and whether or not you want a temporary annuity. That's very important to get some professional advice. Also, the BC Retired Teachers Association, they have pension seminars for people who are about to retire as well. They also have a wealth of information on their website specifically for retired teachers, and they can help you connect with other retired teachers around the province. Finally, you can also contact us here at the BC Teachers Federation, the Income Security Division. We handle the salary indemnity plan as well as pensions. So if you need to contact me, my email address, slally@bctf.ca is up there, as well as my direct line, 604-871-1949. For the salary indemnity plan, Alan Lee is the plan administrator. Many of our members retire after having been on the salary indemnity plan for the last part of their career. And so their questions regarding their entitlement to SIP benefits and terminations, etc., those are best addressed by Alan. If neither Alan nor I are available, you can always contact our director, Chris Harris, and his information is up on the screen as well. So thank you for attending this presentation, and have a great day. And as I mentioned earlier, I do have some mini seminars available on the BCTF YouTube page along with this seminar, so you can come back and view it anytime you want. Until next time, take care and have yourself a great day. Bye-bye.